They dumped 1.8 billion ounces of paper silver in a single day, and physical buyers went nuclear. You're watching finance currency, and today we're breaking down exactly what happened, why it matters, and what almost nobody in the mainstream is willing to spell out. Before we start, quick ground rules. This is not financial advice. I don't sell signals. I don't run paid groups. I don't manage anyone's money. I will never DM you asking for crypto, for funds to manage, or for some private investment opportunity. Anyone doing that in the name of finance currency is a scammer. Block and report them. My only goal here is to break down what actually happened using data, logic, and history so you can think for yourself. Let's get into it. On this particular Friday, the silver market went through one of the most extreme sessions in modern history. On the screen, the story was simple. Silver's price crashed roughly 30-40% in a single day, depending on which intraday points you look at. It was one of the sharpest crashes the futures market has ever seen, but under the surface, the data told a very different, and much more important, story. Roughly 1.8 billion ounces of paper silver traded on COMEX in just a few hours. Annual global mine production? Around 800 million ounces. So in one session, the market traded more than 2 full years of global mine output, not in physical bars and coins, but in futures contracts and paper claims. At the exact same time as this massive paper dump and price crash, something else happened. Physical buyers went insane. One of the largest U.S. dealers, SD Bullion, reported the biggest day in their entire history. They processed about 2.5 times more transactions than their previous all-time record. That previous record was set during the Silicon Valley Bank panic. Friday's revenue actually beat some of their entire months from prior years. Other dealers told similar stories. Websites slammed with orders, phones ringing non-stop, and products going out of stock in real time. Sovereign mints were already behind, and this shock pushed lead times from about 2 to 3 weeks out to more like 8-10 weeks for many popular coins and bars. So we have a strange picture. On one side, a 30-40% crash in the silver price on the screen. 1.8 billion ounces of paper traded, contracts opened and closed in a frenzy. On the other side, physical demand breaking records, inventories tightening, premiums holding firm or even rising, delivery times stretching out. If silver was truly being abandoned, if nobody wanted it, you wouldn't see this kind of physical panic buying. So the question is obvious. If silver is so weak that it crashes 30-40% in a day, why did real-world buyers rush in to grab every ounce they could find? To answer that, we need to look under the hood at how the paper market actually works. Let's separate 2 very different markets that get blended together in one simple price. Quote, on the one hand, you have paper silver, futures contracts on COMEX, options, ETFs, leveraged products, positions that can be opened and closed in milliseconds, exposures that most traders never intend to settle by taking delivery of real metal. On the other hand, you have physical silver, coins, bars, industrial bars, jewelry, silver used in solar panels, electronics, medical devices, batteries, and defense. Metal that has to be mined, refined, transported, minted, and delivered. Paper silver can be created or destroyed very quickly in notional terms. You and I can both take positions worth millions of ounces without either of us ever touching a single bar. Physical silver cannot. There are real constraints. How much is in the ground? How fast it can be mined? What refineries and mints can handle? How quickly it can be shipped where it's needed? On that Friday, paper and physical were telling opposite stories. The screen price screamed, silver is collapsing. No one wants it. The physical flows screamed, silver is on sale, everyone wants it. So let's talk about how 1.8 billion ounces of silver appeared in one day when only 800 million are mined in a year. On COMEX, a standard silver futures contract represents 5,000 ounces. When we say 1.8 billion ounces traded, we're not saying 1.8 billion ounces of metal moved from one vault to another that day. We're saying the notional exposure represented by all those contracts, those bets, was equivalent to 1.8 billion ounces. Think of a big football match. 1 million people can place bets on that game. The notional amount of money wagered on the outcome can be larger than the total payroll of both teams for the entire season. Those bets don't change how the game is played. They're layered on top of the real event. The silver futures market is similar. Many, many layers of bets and trades can sit on top of a relatively small base of real, deliverable metal. 2 key metrics tell us what actually happened that day. Volume. How many contracts changed hands? Open interest. How many contracts are still open after the session closes? On that Friday, volume in the front month March, silver contract exploded to around 345% of closing open interest. In plain English, they traded over 3 times the number of contracts that were still open at the end of the day. After the dust settled, open interest actually dropped sharply. A very large amount of notional silver, over 1 billion ounces worth, had been opened and then closed the same day. That's crucial. If volume is huge and open interest rises, it means new positions are being built and left open. If volume is huge but open interest falls or barely moves, it means a lot of traders jumped in and out intraday. What we saw was the second case. Massive short selling hit the market. Price collapsed. Then a lot of those positions were bought back and closed by the end of the session. They weren't trying to own silver. They weren't trying to deliver silver. They were using paper to smash the price and then stepping out. Now compare this with the state of the physical backing on COMEX. COMEX reports eligible silver, metal stored in COMEX-approved vaults but not committed to meet delivery. Registered silver, metal that is available and assigned to fulfill futures delivery. At the time, registered silver in the COMEX system was roughly on the order of 110 million ounces. Against that, 1.5 to 1.8 billion ounces of notional silver exposure traded in hours. That's around 15 to 18 times the amount of metal actually registered to back delivery. No, it doesn't automatically mean COMEX must default. Most contracts are not held to delivery, they're closed or rolled long before. That's how the system has worked for decades. But it does underline a simple point. The ratio between paper claims and deliverable metal can be huge. If a large enough fraction of longs decided, I don't want cash, I want bars, and stood for delivery in a key month, the system could come under real strain. And remember, the month this action was concentrated in was March, a major silver delivery month. So ask yourself, if registered stocks are around 100 million ounces, and notional trading in one day hits 1.8 billion ounces, why would big players want to crash price violently in that front-month contract, then close out? One very plausible motive is to shake out longs before delivery approaches, make silver look weak, dangerous, and unattractive so fewer people stand for physical, reduce the odds of a big delivery demand hitting a relatively thin registered inventory base. Again, we're describing mechanics and incentives, not accusing any specific institution of a particular illegal act. The regulators can decide that. What we can say is that the pattern, enormous intraday paper volume, brutal price smash, contracts opened and closed rapidly, little indication of a physical surplus, fits what many analysts call short-term price suppression via paper. Now, while this was happening on screens, real people were making real decisions with their money, and they voted the opposite way. Physical buyers treated the 30-40% crash like a flash sale. Long-term stackers who've been waiting for a big dip pounced. Industrial users with forward visibility on their needs quietly locked in cheaper metal. Retail investors who've studied the long-term supply and demand picture saw a once-in-years opportunity. Dealers reported a spike in transaction volume and total revenue. Larger average order sizes than usual, some products selling out quickly. Physical premiums, the amount you pay over paper spot, holding or even rising despite the supposed collapse. Sovereign mints and large fabricators had their own issues. Limited availability of blanks, the discs used to mint coins. Production lines already near capacity after a strong period of global demand. As orders surged, they began quoting delivery times not in days, but in many weeks. Lead times that had been 2 to 3 weeks stretched to 8 to 10 weeks on a widespread basis. That's not what a dead market looks like. That's what a tight market under stress looks like. If silver was truly in a glut, if demand had fallen off a cliff, you'd see inventories piling up, mints and refiners begging for orders, discounts everywhere. Instead, we saw a paper crash and a physical scramble. That's the core contradiction. The price on the screen did not reflect the behavior in the supply chain. It was primarily reflecting what heavily leveraged actors were doing with contracts, not what end users and long-term holders thought of silver's real value. Now let's zoom out further, because this day didn't happen in a vacuum. It happened in a bigger macro context that actually makes the physical story more logical. In the background of all this is a simple and brutal math problem: debt. For years, the narrative has been, if central banks raise rates aggressively, precious metals are finished. If the dollar is strong, gold and silver must collapse. In the very short term, rate expectations and dollar moves can absolutely hit metals. They move markets algorithmically. Headlines about hawkish policy or a tough-talking Fed can trigger selling. But in the long term, you cannot ignore the scale of the debt. When Paul Volcker, the former Fed chair, jacked interest rates above 15% in the early 1980s to crush inflation, U.S. debt to GDP was about 30%. That meant the government could afford extremely high interest rates for a time. Interest payments didn't consume the entire federal budget. Today, debt to GDP is well over 100%. The U.S. is adding trillions in new debt at a rapid clip. Annual interest payments are already pushing toward and beyond $1 trillion and rising. If policymakers tried a genuine Volcker 2.0 with double-digit rates and held them there, the interest bill alone would explode. A huge share of tax revenue would go just to interest. Social programs, defense, everything else would be crowded out. So when markets sell silver 30-40% in a day because the Fed might get serious, there's a disconnect between headline narrative and mathematical reality. High real rates for a short period can hurt metals. Sustaining ultra-high real rates in a heavily indebted system is another story entirely. That's one reason big, patient money often sees extreme dips in gold and silver as opportunities, as long as the long-term debt and currency backdrop hasn't fundamentally improved. And it hasn't. Now add another layer. Silver isn't just money. It's an industrial and strategic metal. Silver is critical in solar panels, photovoltaics, electronics and circuit boards, electric vehicles and charging infrastructure, medical uses, from coatings to instruments, defense applications. At the same time, governments are talking more and more about strategic mineral stockpiles, reducing dependence on rival nations for key inputs, securing supply chains for the energy transition. You'll often see official lists naming lithium, cobalt, nickel, rare earths. Silver sometimes isn't mentioned explicitly, but the reality is simple. There is no serious electrification, no aggressive solar rollout, no massive digital expansion without silver. Combine that with multiple years of reported physical deficits in the silver market, demand exceeding mine supply plus recycling, long lead times for bringing new mines online, growing industrial usage trends, and then ask, does it truly make fundamental sense for silver to lose 30-40% in a day based on a policy headline while debt is still expanding, industrial demand is strong or rising, and physical inventories are tight? From a long-term perspective, the answer doesn't look like no one wants silver. It looks more like someone really wanted the price lower now. Another critical piece of the puzzle is global demand, especially from Asia. India, for example, has been an enormous buyer of silver in recent years, in some years absorbing hundreds of millions of ounces between jewelry, investment, and industrial uses. Silver, like gold, has deep cultural roots there as a store of value and a savings instrument. When Western paper markets smash the price, physical metal can flow more aggressively from west to east. Low prices don't destroy demand in India and parts of Asia, they often stimulate it. We've seen a similar dynamic in gold for years. Paper selling in New York and London, physical buying in China, India, and the Middle East. Gold moving from Western vaults to Eastern hands. Silver may be following the same pattern. When futures traders dump, Eastern and long-term buyers quietly accumulate. Then consider broader economic signals like manufacturing PMIs. A PMI reading above 50 generally means expansion. When PMIs surprise to the upside, it usually implies stronger industrial activity, which should be good for industrial metals like copper and silver. Yet we see days where PMI data comes in strong, indicating expanding manufacturing. And still, silver and copper get slammed in futures trading. Again, this tells you that short-term price action is often dominated by leverage, positioning, risk-off moves at large funds, rather than a clean reflection of physical industrial demand. Over the long run, fundamentals usually win. But in the short run, the pricing mechanism can look very distorted. Now that we've laid out the mechanics and the macro backdrop, let's talk about what this all means for you. Because understanding is one thing, acting rationally is another. Start with the bearish side, because pretending that it's all fine after a 30-40% crash is just as dishonest as pretending silver is finished forever. Here's what can still go wrong. First, volatility is simply off the charts. A move of this magnitude in a single day is not normal. It tells you there is a lot of leverage in the system. Small changes in sentiment or policy expectations can trigger huge swings. Stops get run, traders get liquidated, and normal risk management can fail. Second, margin hikes can amplify the pain. After major volatility, exchanges like COMEX often raise margin requirements. That means you need more capital to hold the same positions. Traders who were borderline suddenly don't have enough margin and are forced to close. That creates additional selling pressure, sometimes into already weak markets. Third, you might be in a broader commodity and risk-off environment. If funds are de-risking across the board, they don't sell only silver, they sell baskets. Positions in copper, energy, grains, and metals can all be cut at once. Silver can get hit simply because it sits in the same complex, regardless of its own fundamentals. Fourth, equity market structure is fragile. If stock indices are extremely concentrated in a few mega-cap names and we get a serious equity correction, funds will sell what they can, including metals, to meet margin calls and redemptions. In true liquidations, everything can go down together, at least temporarily. Finally, there's psychological damage. New investors who just stepped into silver can see a 30-40% drawdown and decide, this market is a scam. I'm never touching metals again. That's understandable. Volatility and perceived rigging can scare away a whole generation of potential long-term holders. So yes, from here it's entirely possible that we see more violent swings. We revisit or even break intraday lows. Or we grind sideways for a painful period while people rebuild confidence. But now look at the bullish case, the side that physical buyers were clearly focused on when they went nuclear. First, structural deficits don't vanish because of one ugly session. If silver demand from solar, electronics, investment, and other industries continues to outstrip total annual supply, then a one-day paper crash hasn't solved that. It might even make it worse by discouraging new mine investment. Second, physical tightness is a fact, not a theory. When dealers report record order volume, shelves emptying, premiums steady or rising into a crash, And mints quoting 8-10 weeks for delivery, those are operational realities. That's not a chart setup, that's logistics. Third, history shows brutal corrections inside long-term bull markets. In the 1970s, gold had multiple 30-50% corrections on its way to massive gains. Many times people said, "It's over, the bubble popped." Those who understood the structural drivers, inflation, monetary system stress, geopolitical risk, and kept their time horizon long eventually saw a large upside. Silver has a history of being even more volatile than gold, both up and down. Fourth, a sustained paper price that's too low can sow the seeds for future shortages. If miners can't operate profitably at depressed prices, they close marginal projects, cut exploration, and delay expansion. That's future supply that never comes to market. Meanwhile, industrial and investment demand don't necessarily fade just because the chart looks ugly for a year or two. Eventually, the physical market forces a repricing. Fifth, events like this wake people up. A lot of investors who assumed the price on the screen must be fair, or markets are always efficient, start digging deeper after watching 1.8 billion ounces of paper trade in a day while physical dries up. They discover the difference between allocated and unallocated metal, the leverage in the futures system, the gap between paper claims and actual bars. That often leads to more interest in owning metal outright, more skepticism about purely paper exposure, a shift in mindset from trading to custody. So what should an individual do with all of this? Again, not advice, just a framework to think clearly. First, get your time frame straight. Are you trying to trade silver on a days to weeks basis with leverage, or owning silver as a multi-year or multi-cycle hedge speculation? Because these are completely different games. Leveraged futures and short-term trades live in the world of stop runs, algos, margin calls, and sudden dumps like the 1.8 billion ounce day. Long-term positioning lives in the world of supply and demand, debt and currency regimes, industrial use trends, and long cycles of fear and confidence. Don't mix the two without understanding you're stepping into a meat grinder. Second, respect leverage. Many people who are fundamentally right about silver's long-term story still get wiped out because they use too much leverage. They couldn't stomach 30-40% swings. Margin calls force them to sell at the worst possible moment. Ask yourself, can I really handle this volatility? If silver drops another 20% from here, am I forced to sell or can I hold? Third, understand what you actually own. Owning a futures contract, a synthetic ETF exposure, an unallocated pool account, allocated vaulted bars, or coins and bars in your possession are all very different things. In a world where 1.8 billion ounces trade on paper in a day, COMEX registered stocks are only around 100 million ounces. It matters a lot whether you own a claim or the thing itself. Fourth, diversify your thesis. Not just your holdings. It's fine to have a strong view on silver. It's dangerous to build your entire life on a single narrative. Silver can be a hedge against monetary chaos, a long-term speculation on industrial and energy transition demand, a savings vehicle outside the banking system. But it shouldn't be the only pillar holding up your future. Pair it with other assets and strategies that make sense for your situation. Fifth, stay data-driven, not emotion-driven. It's easy to get angry at manipulation, and there are certainly days where price action looks designed to shake people out. But anger doesn't protect capital. Information does. Use days like the 1.8 billion ounce dump to ask, who's being forced to move? Who is quietly buying? What's happening in physical inventories, not just on a screen? Are premiums rising or falling? What are mints and refiners saying? Finally, let's summarize what really happened in one tight picture. They dumped roughly 1.8 billion ounces worth of paper silver on COMEX in a single day, more than 2 years of mine production in a matter of hours. Volume in the front-month contract exploded to around 3.4 times the open interest. By the end of the day, a massive amount of those contracts had been closed. Open interest dropped. COMEX registered stocks sat near 100 million ounces, a fraction of the notional volume traded. On screens, silver crashed 30-40%. In the real world, physical buyers broke records. SD Bullion did 2.5x their previous all-time record day. Other dealers saw surging orders and product shortages. Sovereign mints pushed delivery times from 2 to 3 weeks to 8 to 10. Premiums held or even increased into the crash. Macro reality didn't suddenly improve. Debt is still enormous and rising. Long-term ability to keep real interest rates very high is limited. Silver's role in energy, technology, and industry is growing, not shrinking. Structural deficits in silver haven't been miraculously fixed by a single paper sell-off. So from where I sit, this doesn't look like silver is finished, nobody wants it. It looks more like a highly leveraged, thinly margined paper market was used to nuke price in the short term, while people who understand the physical and macro story treated it as a discount window. You don't have to agree. You shouldn't agree blindly with anyone. Look at the COMEX data yourself. Listen to what mints and dealers are saying. Study the debt numbers, the industrial demand, the stockpile policies. Then decide what role, if any, should silver play in your strategy. How much volatility can you actually handle? And do you want pure price exposure or do you want real custody? If this breakdown helped you see the picture more clearly, do 3 things. Subscribe to Finance Currency so you don't miss future deep dives like this. Hit like so this kind of analysis can compete with the shallow hype and noise. Drop Finance Currency in the comments so I know you watched to the end and got value. No signals, no private groups, no DMs asking for money. Just data, structure, and context to help you think with your own brain. This is Finance Currency. Stay sharp, protect your capital, and I'll see you in the next one.